everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 437 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to be talking about one of the primary ways that people build wealth in America today, and even though it may not be the best or my favorite at all times, it is very relevant, and that is the 401k. So we're going to talk about the 401k a little bit, but we're specifically going to be talking about whether or not you should max out your 401k, and if you do, how should you max out your 401k, or does it even really matter, right? And is it feasible? Is it something you actually can do? So this is going to be a very good discussion of one of the primary financial tools that people use. So I think you can get a lot of value out of this. And if you don't have a 401k, that's okay, because if you have a 403b, a TSP, any type of employer-sponsored retirement account that gives you a match or whatever, you can do the exact same type of thing as I'm talking about here, and the results are still the same. So stick around for a discussion of all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. Then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. Now, if you guys follow this show at all, you know that I really teach and push on what's called the financial action plan, right? My plan for helping you achieve long-term financial freedom. Right? And it's a foolproof plan, and some may argue it's not a perfect plan, maybe not, right? But it is a plan that works. It's something that's effective, and it can get you to financial freedom and financial success. Now, within that plan, something that I tell you to do very early on, if at all possible, is to take the match if you have an employer-sponsored retirement account, right? And the reason I tell you to do this, and this is the third part of the financial action plan, after you budget uniquely every month and have a month's worth of expenses in a small emergency fund. The reason I tell you to do this, and I tell you to do it so early in the plan, is that you're not going to get free money in many places in life. And rarely will you get near as much free money as what is offered to you via a 401k match, for instance. Right? So taking that is very, very important. Now, just because I put that so early on in the plan does not mean that 401ks are the best way to invest at all times. It's not true, right? I think that they can be very useful. I think they can be valuable. And for some people, it may be the best option that they have. But for the vast majority of us, you have multiple options when you invest. Now, for people who are aggressively investing, and when I say aggressively, I'm not talking about aggressively in the nature of like risk return, right? I'm not talking about like investing in more risky investments. I'm talking about aggressively like you're investing a lot, right? You're at the point either where you are investing at least 15% of your income, right? And 15% of your income may be a very large amount depending on what your income is, right? Or you're maxing everything out in the 8th part of the financial action plan. Whether you're doing either one of those things, this episode can really be useful for you. Okay, and the reason that is because a lot of people who are putting that much money away are going to at least partially dip into using a 401k or using some type of employer-sponsored retirement account due simply to the contribution limits associated, because 401ks have very high contribution limits relative to, let's say, an IRA or something like that. I think currently the 401k, you can put $20,500 a year, and for the IRA, it's $6,000, right? So quite the big disparity. Because if you think about $6,000 a year, right, and you're saying that needs to be, okay, 15% of somebody's income, right? Well, $6,000 a year is, out of a $40,000 net income, 15%, right? And so, I mean, maybe that person makes $55,000, $60,000 a year, maybe, right? And what about all the people who make more, right? They need more options. I mean, if you're making $150,000 a year and you're trying to put away, 15% of, let's say, your gross, that's $22,500 annually that you're going to be investing. And I mean, if you're maxing things out, if you're past that point, you've got your mortgage paid off, you're investing more than 15%, then you need more options because you're going to be doing some very, very heavy investing. So a lot of people go through my hierarchy, right? They go through the hierarchy of what to invest in. And I'll tell you what you should invest in or what I think you should invest in. Obviously not specific investments, but account types based on the fact that these accounts have different rules and they have different advantages for you as an investor. So the first place that I think just about anybody should be investing, other than taking an employer match, because I think that's primary, right? That's why I put it in the financial action plan, right? You take an employer match. Okay, now what, right? Whether it's traditional, Roth, 401k, 403b, get the free money, then next thing, okay? After you get the free money, then go and see, okay, can I contribute to a Roth IRA? And the truth is that, at least with regulation as it currently is, IRS code being as it currently is, anybody can get money into a Roth IRA, right? But maybe not directly. You might have to do the backdoor Roth if you make more than a certain amount. So you can go look at those income limits first, right? But start with the Roth IRA, right? And if you're married, start with the Roth IRA for you and your spouse, right? That's $12,000 a year that can go ahead and be put away between the two of you, which is extremely valuable, right? $12,000 a year is a very significant amount of money, right? That's a significant amount of investments over a long period of time if you just invest $12,000 a year, right? And that's 15% of $80,000 is that $12,000 annually, right? So that's a pretty good amount of money to be investing. But maybe you're maxing out, maybe you make a lot of money, maybe you want to invest more than 15% and you want other options. Maybe you're not married, right? And you can only put money into one Roth IRA, so it's just $6,000 and you need to invest more. Then what? Where do we go? Then what I would do, I would begin to look at the retirement account that you have offered to you by your employer, right? So if you're already taking the match in your employer-sponsored retirement account, you're already putting something in, right? But then you can look and say, okay, do I have a Roth option? And if you do, take that Roth option within your 401k, 403b, whatever, as long as you're still getting your match and things like that, and start pouring money into that up to the contribution limits there. And or if you don't have the Roth option, you can take the traditional option, and then anything past that you want to invest into just brokerage accounts. And you can be putting money into a brokerage account even before that if you're trying to do some bridge investing, like or investing for a specific purpose down the road where you want to be able to get to your money, because there are limitations to when you can get to your money if you're investing in IRAs, 401ks, things of the like, right? So you want to take advantage of those tax-advantaged investments, but you don't want to do so necessarily to your own detriment. Now, to get to the point, based on that hierarchy, where you would put away the max into a 401k in a year, I mean, you're probably investing, let's say it's you and a spouse, that's $12,000 into IRAs. You go over to the 401k, and that is $20,500. Let's just say one of you has a 401k, right? Because if there's two of you, then you could put $41,000 between the two of your 401ks. But let's just say that's not the case, right? Let's say it's $20,500 plus that $12,000, right? That's $32,500 that gets invested in a year. And so if you were investing 15%, that's 15% of $216,000. So not many people are going to get to that point. Now, some people invest just in their 401k out of convenience, right? It's more convenient to invest in your 401k because you're automatically enrolled or, whatever, right? And so people just put money there and don't worry about Roth IRAs or whatever, especially if they have a Roth 401k offered to them. But I still think the Roth IRA gives you more options, gives you more choices. You can invest at a lower cost typically as well. And so I think there's value there. But let's say you are a person who invests heavily in your 401k. Maybe you do max out your 401k every year. Maybe you're not leaving anything on the table when it comes to 401k. investment, right? So then the question becomes, should you max out your 401k early in the year or just contribute normally, right? And so this is a question in this blog post by Nick Majuli, which I think is a fantastic post. And he says, though I'm not the biggest fan of maxing out your 401k, especially for young, aggressive savers, there's some evidence that maxing out earlier in the year can provide some benefit over maxing out by year end, right? So this is typically going to the argument of, okay, should we dollar cost average or do a lump sum investment? And I've talked about that before on this show. And basically that argument's just, okay, I have this amount of money that I can invest. Should I just average in over time, just buy every month, buy every 2 weeks or whatever, however often you get paid? Should I just buy and the summation of that money be the amount of money I was going to invest? Or should I take all that money I was going to invest and invest it all at once at the very beginning of the year? And typically the statistics show that investing at the beginning of the year will work better, right? Lump sum investing will work better because time in the market is just so valuable, because markets tend to go up. And since markets tend to go up, there's a slight advantage to getting your money into the market sooner rather than later. Of course, after a 1 year period, the difference between doing your contributions in January, so maxing it out early, and doing the contributions throughout the year will be quite small, even when investing in a 100% US stock portfolio. Obviously, the difference is going to be greater for an all stock portfolio, typically because of the risk return relationship, right? Now, in fact, since 1978, when the 401k was first introduced, the biggest difference between maxing early and averaging into a 100% stock portfolio over 1 year was about 13 to 15%. So this means that for a $20,000 contribution, choosing one strategy over the other would have netted you as much as $2,000 to $3,000, but that's only in the most extreme years, right? So typically the amount of outperformance you get by following one of these strategies for a year is under $1,000, or about 5% of total contributions. Now that's still a win, right? You're still winning in that case, but just not by as much. So if you were looking at the distribution of how much max early outperforms the average in over the 1 year period, what you see is that max early outperforms, but it doesn't outperform so extremely that it's like, I would definitely do that in all cases, right? It's not necessarily the case. Now, long story short, if you're deciding to whether to max out your 401k early for just 1 year, it doesn't really matter what you do. Yes, statistically, maxing early provides a slight advantage, but that advantage isn't all that big in the grand scheme of things. So when does your maxing actually matter, right? Well, your maxing might actually matter if you do it for multiple years in a row. So though 1 year won't make a difference, right? And this is true in just about anything. So let's just stop right here, right? The reason that is the case, the reason that averaging in can outperform more over the course of a year is based on this simple concept, which if you guys have ever read Stocks for the Long Run, is very well explained throughout that book. And what's explained is that your risk of investing in a year is very, very high, right? Your risk of loss if you put your money into stocks for a year is very, very high, right? But your risk of loss for putting your money into stocks over many, many years actually becomes very, very low, right? Jeremy Siegel even shows that's the author of Stocks for the Long Run, even shows that bonds become more risky than stocks if they're held for a 30-year period, right? And obviously stocks are making higher returns. So the risk return relationship actually flips there in the stock's favor. So this is basically the same argument, because it's saying, okay, the longer time over which you do this, the more it might actually work for you. It might actually matter, right? Because in 1 year, stock market may underperform, and so averaging in would be better, right? But over many years, stock market's likely just going to keep going up, and so the quicker you can get in, the earlier you can get in, the better it will be, right? So though 1 year won't make a difference to your financial plan, the data suggests that doing this for many years can have a sizable impact. So for example, imagine you compare maxing early versus averaging in for 10 years in a row, right? So 10 years in a row, you put $20,000 in January, while you averaged in you compare to averaging in $1,667 a month for 12 months. After running the simulation and comparing the performance between these two strategies since 1978, the clear winner is maxing early, right? It's very, very clear, okay? In absolute terms, the typical performance difference is $11,500 in favor of max early, or about 4 to 5% of total contributions. In the grand scheme of things, this still isn't a ton of money, but it's not negligible either, right? After examining both the 10-year simulations and the 1-year simulations, a pattern emerges. The typical outperformance of max early over average in is about 5% of total contributions. So this is a rough approximation of what you would expect if you follow this strategy for a number of years. So if you were to max out your 401k earlier in the year for 20 years, you should expect to have about 5% more than if you didn't max early. So on $400,000 in contributions over 20 years, this means an extra $20,000, right? And so this is beneficial, but still the benefit is not quite as huge as you may think. So while it's nice that the evidence matches the theory, then you really haven't looked at the fact that, can you do this, right? Is this strategy even feasible? So while maxing out your 401k early in the year could provide you with some benefit, the number of households that could do this with ease is quite small. Because think about this. You must come up with $20,500 in contributions over 2 paychecks. Not many people are able to come up with $20,500 to invest over the course of the entire year, right? But to do so over 2 paychecks. So that means that this strategy is limited to someone making at least $240,000 a year. And that would be at the absolute minimum, right? That would be somebody who puts all of those first 2 paychecks into their 401k. But you would likely need to make much more so you could live for the month of January as well. So of course, if you make less than this, you could still max out over the first 2 to 3 months of the year, but the benefit would be smaller than the 5% that we've highlighted here, right? So nevertheless, just because this strategy isn't feasible for most people with a 401k doesn't imply that it isn't feasible in other retirement accounts, right? So the 401k is not the only place that this can matter, right? And so this is where we kind of shift gears and we say, okay, not only just the 401k, but what about like the Roth IRA? So if you were to max out your Roth IRA, which is far easier to do in a lump sum than a 401k is, right? Because the contribution limit's much lower and you don't have to deal with, your workplace and saying, hey, I'm going to put all this money extra in at the beginning and, whatever, right? So if you were to max out your Roth IRA by contributing $6,000 in January, instead of throughout the year, your expected benefit would be about $300 or 5% of the $6,000 in a year. Yes, $300 isn't a lot, but do that every year and it can add up over time. So whether or not you choose to max out one of your retirement accounts earlier in the year is up to you. Even though there's not a huge benefit to doing so, every extra dollar you get is valuable, right? So this is especially true if you max out early over many years in a row. So what is my suggestion on the back end of this? My suggestion is this. If, in fact, you can find a way to get ahead of your investing, and this is something I don't even do currently, but I've known it statistically, and it's something I may try, right? At least with some amount of money. Maybe it is with my Roth IRAs. Maybe it's, I don't know, right? But if you can get to the point where you can just front load your Roth IRAs with $6,000, right? And just do it straight up, right up front and get it over with, I would do so, right? Now, this may require you doing some extra saving for a year or something like that so you can go ahead and get ahead of the next year's investing. It may be something that you have to do that way, but nonetheless, this may be a very, very good option. Or maybe you've got some money like in a taxable brokerage account that either you don't have a ton of gains on, or you could get out for a very low cost or no cost at all, or maybe you've taken some losses and you can get some tax losses there that you can harvest and take some of that money and put it directly into your IRA to get yourself started. And then throughout the year, what you can do is just save up what you would have put in your IRA, and then the next January front load the IRA again, and just continue doing it in that way. That way you're maxing it out every year and you are able to take advantage of the continued growth of the market over time, right? either way, I think the big point is this. This is not a decision to stress yourself out over, right? The benefit of doing this is not worth the mental cost, right? So ultimately, if you're somebody who is happy with dollar cost averaging, which honestly, I'm pretty happy with dollar cost averaging. It's not difficult. You never miss the money. It's not something you have to think too much into, nor do a whole lot of saving for. Then by all means, just keep doing it. But the point here, and I don't want you to miss this, right? But the point here is that you invest, okay? And you may say, well, of course, Dylan, if I've listened this far, then of course I'm going to invest. Look, I get it, right? But I want you to be pushing towards this idea of maxing out your investments, right? And that's the 8th part of the financial action plan. And so before we get there, we have to do all these other things in order to follow the plan, right? What we're doing is we're budgeting. We build a small emergency fund. We're taking on our employer match, right? We get out of all consumer debt other than our mortgage. We build up an emergency fund of 4 to 6 months of household expenses. Then we start investing at least 15% of our income. We pay off our mortgage, right? We pay off our mortgage, then we start maxing everything out, okay? And when you're maxing everything out, by all means, try these strategies out. Try to do what you can to get the leg up. Especially, and this is not even in the case of just maxing things out. This is just the context by which this article was written, is like if you max everything out. But let's say that you know how much money you're going to put away every single month into your 401k or into your Roth IRA over the course of a year. And you can front load that amount into those accounts. It may not make as big a difference, but ultimately, if you continue doing it for many years and years and years, then you will have a leg up on yourself had you just dollar cost average yourself in over long periods of time. Now, the truth of the matter is many of us just dollar cost average ourselves in. And what this doesn't take into account as much is the idea of the number one indicator of having wealth in your 401k, in your Roth IRAs, whatever. That indicator is not rate of return, right? Which this actually is underlying this argument, right? Is that you'll make greater returns by being invested longer, right? It's not even, the length of time that you're invested. It's neither of those, right? What it is that you're actually putting money in. You're actually actively going about your investing life, taking time, investing your money in a very intentional way. And so that's the important thing here. The important thing is that we actually invest, that we actually are taking time to think about these things. And so the amount of money that you put away is way more important than the nominal or marginal difference in, investing early in the year or late in the year or whatever, right? Do what you need to do what is most comfortable for you. And if you can't front load, then don't front load. I'm not suggesting that everybody has to do this, but what I'm saying is it can provide a little bit of value. But more than anything, what I'm concerned with is that you actually take the time out to decide, okay, I'm going to invest. I'm going to take my employer match. I'm going to put away 15% of my income, even though my income may not be extremely high. Like I was saying before, if you make $40,000 a year, $6,000 is 15% of your income. And if you look over, let's say you made 8% a year, and you did that for 30 years, putting away $6,000 annually. So that's $500 a month. You start with nothing. That still gets you to $745,000 over that 30-year period. You increase your rate of return to 10%, and that's $1.1 million, right? So even if you're not making a ton of money and you can't front load in the same way that somebody who's making very large amounts can, that doesn't mean that you can't do something and begin to accumulate wealth over time, because you absolutely can. But you have to believe that you can. You have to know that putting money in is what's actually going to get you to where you want to be on the other side of your investing life. So that's what I want for all of you guys. I don't want you to get so bogged down in something that's going to provide you marginal benefit. I want you to know that those things exist. I want you to take every advantage you can take for yourself over the long run, but I don't want you to get so bogged down in it that you forget what's important. What's important is not the strategy, is not really even the investments to a great extent, right? Even though those have some benefit, obviously we talk about them a lot, and knowing what to invest in is important. Your asset allocation, your diversification, stocks, bonds, it's all important, right? But it is just not near as important as your decision to actually invest, to actually decide I'm going to defer gratification. I'm going to put money away over a long period of time, and then I'll have that money for myself later on. I'm going to live, to take words out of Dave Ramsey's mouth, right? I'm going to live like no one else, so later I can live and give like no one else, right? We're going to live a life right now that is going to, delay gratification, so that later we don't have to delay gratification, so that later we can actually have something to live on, and be the best stewards of our money that we can be. So again, hopefully this is helpful to you. Hopefully I'm giving you guys the message that you need. If you are a high income earner and this is something that you think could provide you some benefit, great, right? Know that this is not just applicable to the 401k. This is applicable to any investing that you plan to do systematically. If you did it earlier and just continued over time doing it, it will provide you some marginal benefit. So just keep that in mind as you go into your investing, as you invest in a 401k maybe. But ultimately, just invest your money. Just put money away and do it every paycheck over and over and over again. You will not regret it. It will be what gets you to long-term financial freedom, which is why part of the financial action plan is not, max out your 401k, but do it early on in the year. That's not such a fundamental step that we must do it, but it's something that can provide you a little value. And it's something I wanted to talk about with you guys in today's episode. So hopefully this is useful for you guys, and you can take something away and apply it to your own investing life. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcast, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. Then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to the show on a day-to-day basis. So tune in tomorrow as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.